Hey, good morning. This is Jim Harvey, and this week I want to talk about the issue of concern about rising interest rates. I mean, everybody's saying, oh my gosh, interest rates are going up, that's the end of the world. And I'm here to tell you that I don't see it as endlessly rising interest rates. I do think interest rates are rising, but a big part of that has to do with what the Fed did coming out of the credit crisis. They lowered rates to zero. Which quietly recapitalized the banking structure in the US, which was in serious trouble at the time, and huge leverage in the system. But just because rates have gone back up doesn't mean they're going through the moon. So let's explore this in more detail. Here's one of my favorite websites that I use in my lectures at Stanford and Wharton and Berkeley, despair.com. And this one is despair. It's always darkest just before it goes pitch black. Is it really this bleak? All right. Let's talk about Fed fund hikes, because we've seen a lot of that and it's in the news quite a bit. And as you can see that over here in 2009, Fed funds dropped to zero. Remember I said they dropped it to zero, and it was zero for like 5-6 years. Then it started to creep back up, and then COVID hit and it dropped to zero again. Now it's coming back up. So we're seeing this big rise, but it's rise from zero. Just to give you a sense of perspective, I got into the business right here in 1983, but Fed funds peaked at 22%. 22%. And remember, the Fed funds rate is the rate at which member banks can borrow from the Fed. Can you imagine being a banker and saying, yeah, let's put some money, let's borrow some money at 22%? No. All right. So keep it in perspective. When people say, oh my gosh, it's up 300%. Well, it's 300% off zero. So don't panic. The other thing about it is, and this is a really interesting thing, what has the S&P index return done following the last 5 major Federal Reserve interest rate hikes? And those dates were 1994, 1999, 2004, 2015, and 2018. Well, on average, over those last 5 hikes, the S&P was up 13% after 6 months, 13.6% after 12, 26.4% after 18, and 35.2% 2 years out. So again, just because the interest rates are going up doesn't mean the stock market doesn't do well. So keep that in mind. Now, another thing that a lot of people are talking about with interest rates has to do with the mortgage rates. Now, there's a saying in our business that says mortgage rates are the last to go up and the first to drop, but it's actually the opposite. We're seeing big spikes in interest rates on mortgages, and of course that affects the price that sellers can get for selling their houses. But again, to keep this in perspective, 30-year fixed mortgage rates peaked in 1981 at 18.5%. I bought my first house here in Seattle in 1987, and my rate was 9 3/4. Recently, I bought a house up on Orcas Island, and my rate was 3 1/4, and now it's probably like 6 for a 30-year mortgage. So again, oh my gosh, things are up 100%, but not as much as it has in the past. So, is it higher? Yes. Is it on its way back to 18? I don't think there's a chance on God's green earth that that'll get back up that high. So, and by the way, these gray areas represent recessions. So over this 52-year period, there have been 7 major recessions. Inflation, the average selling price of homes clearly has gone up. Through Q2 of this year, it was up to $507,000. It's probably come down a little bit since then. But obviously the price of homes has gone up. But the 2-year treasury is an interesting one. Right now it's about 4-point-something%, right at 4.3. But it peaked in 1981 at 16. Imagine being able to give money to the federal government in the form of a 2-year bond, and they would pay you 16.73%. I mean, where do I sign up? I'd love to do that. Of course, inflation at the time was 13. And I love this quote from Benjamin Disraeli, two-time prime minister in the 19th century of the UK, where he said, there are lies, damn lies, and statistics. So, if all we were looking at was 2020 to 2022, my gosh, rates are up 400%. Yeah, but historically, still not even close to where it had gone up to. The 10-year treasury, similar. and it peaked at 16.73%. Demand deposits, which is consumer savings, are as high as I've ever seen them. And why is that important? Because 70% of our economy is based on consumer spending. And so it'd be one thing if consumer spending was down, but it's not. People have been saving, especially coming out of the credit crisis, and then the COVID situation, where people weren't out and at restaurants and bars and spending as much money. They stayed at home, so they were able to save a lot more money. So that's another reason why I think inflation may not be as big a factor, because we do have the wherewithal to spend. In May of 2022, demand deposits were up at 4.9 trillion. Now, when rates go up, it affects price. So here are some current key fixed income rates 12 months ago and what they are now. And when you look, for example, the 2-year Treasury 12 months ago was 0.29%. Now it's 4.2. If you look at the 10-year, it was 1.53. Now it's almost 4. You look at U.S. corporate bonds, were 2.13% a year ago, now 5.69. U.S. municipals were 1.12%, now at 4. High yield, it was 4.09, now it's 9.58. And U.S. loans, our senior loans, bank loans, 4.19, now at 8.47. Now, again, with the Callan chart, you'll see that you can't predict which part of the fixed income world is the best place to put it in any given year. Here's high yield. It was third from the top, third from the bottom, second from the bottom, the top, up. You're never going to be able to figure out in advance what's going on, although quite frankly, high yield looks pretty interesting. Here's the municipal bond market. And as you can see, the total return numbers, when your rate goes from 1.2 to 4, you lose 11%. So what's made this particular stock market decline unusual is the bond market has declined as well, because interest rates have gone up. Typically what happens is that when people leave the stock market, they say, oh, give me the bond market. Only that wasn't a place to put money, and people were selling out of the bond market now as well because rates were going up. I would argue that rates are going back up to an equilibrium level that is more normal. When I taught at Wharton, I was teaching the Sharpe ratio, and you use the risk-free return, which was the proxy for that was a 90-day T-bill. And the number we typically use, this is back in 2003 to 2008, when I taught there, was 3%. Imagine that. You can get 3% by giving your money to the government for 90 days. So we haven't seen those kinds of numbers in a long time. I am arguing that we are having it come back to a more normal equilibrium rate, and we'll have a better idea like a year or two from now what it's going to look like. But you're now going to be able to get some returns from bonds, whereas for a long time, the bond market has been a bull market, meaning rates have dropped precipitously. And when rates drop, bond price and bond yield have an inverse relationship. If rates drop, bond prices go up. What we've now seen is rates are going up, so bond prices have dropped. And as you can see here, if you go down to tobacco bonds that are high yield municipal bonds, 21% drop down 8 on 5 years. One thing to keep in mind as we look at this period of rising interest rates is tax equivalent yield, which basically says, okay, well, investment grade corporates and mortgage-backed securities and aggregate corporate bonds and treasury bonds, they have these nice yields, but those are taxable. If you have a 4.04% municipal bond yield, that's like a 6.8% taxable yield, and none of those other instruments have that. So we think now municipal bonds are pretty attractive, and we'll be looking at those for our clients, particularly with their non-qualified money, if they make a lot of money. So there you go. Another couple areas that we think are very interesting are floating rates and high yields. Right now, floating rates have a yield of more than 8 with a risk spectrum of about less than 2, and high yield corporates are almost 9.5 with risk that's better than treasuries, aggregate munis, etc. So what you can see is this is an anomaly. We think these are two areas to look for yields. Now, the yield curve is a description over time of what different maturities will do. And this was the curve a year ago where short-term rates, you were practically getting nothing, I mean, less than 1% here. But if you went out 30 years, you almost got 2. Now you've got short-term rates almost the same as long-term rates. That was a month ago. And now you actually have short-term rates like 2 years higher than long. So the question is, this is a normal yield curve. What does this mean? Does short-term rates go down and these stay the same, or do short-term rates go down and these go up? I think it's going to be some combination of that. But clearly, things have changed. In corporate bonds, you'll see as well the impact on returns. And it's been, in some cases, down 21, down 18, down 19. So traditionally, we used to say that the bond market was a good ballast for the stock market. But this year has been different because the S&P is down and the bond market is down, kind of a double whammy. And right now, we're taking a lot of tax losses in bonds and waiting to get back in maybe 31 days or longer because we can have those tax losses. In 2021, our clients paid a lot of taxes because the market had been up, the stock market would have been up 3 consecutive years in a row, up a cumulative amount of 72%. We couldn't find any losses. So, as you look at your portfolio, that may be an area where you could find some losses. And then what's interesting here is default rate on high yields and those senior loans being extremely low right now. That's the one thing you have to pay attention to, particularly with high yield bonds, because they are more risky in terms of credit risk. But when you have a yield of 9 and a very low default rate, it becomes pretty attractive to look at. Okay, well, that's what I have for this week on rising interest rates. This is Jim Harvey, president of Opus 111 Group. We hope this has been informative. I encourage you to go to our website, opus111group.com. And in particular, go to the Learn page where you will find these kinds of video blogs, written blogs, podcasts for your general education and to help you make better decisions with your portfolio and hopefully sleep better at night. Have a great day.